The plan that I was going to cover today is why co-living, in my opinion, is the #1 rental strategy for a lot of reasons. Co-living case studies, people like to see like, oh, what do houses look like? What do the numbers look like? I got you. I'm going to show you guys that. That helps a lot when they see the actual numbers or the floor plan conversions. Hey, you went from this many bedrooms to that, what market? So I got several of those. The cost to buy and own co-living properties, so like the cost to acquire it and the expenses associated with it, the income and all that. How to choose a market and a property and like the renovation side of it. Cool, I'm not going to get into who I am, but I own over 100 co-living units. Now it's like over 200 co-living units. Main markets that I own in, well, I do own a decent amount in California, but I don't advise most people to buy in California. If your goal is financial freedom, because you can get more cash flow elsewhere, my thought process is when I talk to Californians, let's arbitrage the money that we make here, the extra money and the extra capital we can raise, to then make a lot more money where investing makes a lot more sense, where the government makes it easier, where the returns are higher, the costs are lower, all that kind of stuff. That's kind of a cheat code we have as Californians because we get to arbitrage California money in not California places. But yeah, my main co-living markets are Georgia, Florida, North Carolina, Texas, primarily, also Denver. I do have some in California, but once again, I don't really advise that to most people because just the risk isn't worth it for you guys. All right, cool. So we'll talk about co-living, capital raising, and creative finance. And I'll kind of try to paint the picture why it all works so well together when you guys ask me, how do you raise money for deals and all that? Well, what you're doing to raise money for a deal is you're providing someone who has money a great investment opportunity. Well, the better the investment opportunity, the easier it is to raise money, right? The better the deals you're providing to someone to partner on, the easier it is to raise money from that person. So co-living makes that more advantageous. And it's easier to build your skills and experience that way. Cool. So we briefly talked about this, but I use this slide a lot when I do any type of training because there's a lot of benefits to real estate investing, right? The cash flow, the wealth benefits of appreciation, debt pay down, tax savings allow you to actually keep that money that you're making, not give it all away in taxes. And then leverage, which is kind of the best part of real estate investing. That's what makes it different than like stocks and all that, is because I can use debt from the bank to fund 75, 80, whatever % of the deals. Same with, I can use creative financing for $1 million property, we'll just say, 5% down, $50,000 to control $1 million asset. Other people's money and the momentum. The more that you learn and the more that you do, the more experience that you have, the easier it is to find deals. The easier it is to get better deals. The easier it is to raise money. All that stuff is true in real estate investing. That's kind of the biggest thing when I was going to retire. I didn't even put that in 2024. And Pace said, dude, you're so dumb. Why would you, just because you have more money than you need does not mean you should retire. It means that you should continue growing and scaling with maybe less time, a little bit more efficiently, but everything's so much easier for you now, and it's only going to get easier and easier because you have momentum and skills and all that. Why stop that unnecessarily? In the future, you might regret it, and you can't go back and say, oh, I should have kept the ball rolling once you have the momentum. Cash flow is cool, but is everyone here familiar with cash on cash return? Right? Okay, so that's like the #1 metric. If you're buying and holding real estate, cash on cash return is #1 if your goal is financial freedom. There's a lot of, like, I buy California properties because I get lots of wealth benefits, appreciation, debt pay down, tax benefits. But if your goal is financial freedom, which is you have more cash flow coming in than you're spending, cash flow gets you there, and then cash on cash return is the best metric to determine what is the best deal that you can buy. It allows you to compare between like a long-term rental and a mid-term rental and a short-term and a co-living, saying which of those strategies is the best. And then secondarily, it allows you to say, hey, is property A better or is property B better? Because cash on cash return is telling you how much cash flow are you generating per each dollar you invest. It's basically telling you how hard is your investment working for you. Even if it's not your own money, every deal that I analyze is analyzed the deal first, and then it's analyzed from the counterpart perspective because my returns are infinite. If I have no money in and I get anything out of it, I get infinite returns, but I still look at the deal itself. And the goal is to get the deals that have the highest cash on cash returns. So that means either a lot of cash flow, well, actually, it quite literally means a lot of cash flow relative to the amount of money I have to put in to buy that property, buy and get it ready for rent. So the only way to increase your cash on cash return is to either increase your cash flow or decrease your entry costs. So your goal should be to invest in rentals that generate you the most consistent cash flow per dollar invested. This is true for every single investor, whether you are a buyer because you want the highest cash on cash return, you want to buy the best deals that generate you the most returns. For capital partners, it's better protection. Like I said, for me to be able to raise money, the easiest way to do it is have great deals because the capital partners are saying, well, I want to invest in better deals. So they're also looking at the cash on cash return. And for bird dogs and wholesalers, because the better the deals that you're trying to wholesale or bird dog to someone, the better the returns, the more money you're going to make on that. So whether you're the buyer, the capital partner, or the active income guy, try to increase cash on cash return, and that's where co-living is the #1 strategy for that relative to like any other residential single family home type of strategy. Co-living allows me to maximize the cash flow and wealth and gives me more investment opportunities. What that means is that I make way more cash flow through co-living than I would as a long-term rental or whatever. It builds more wealth because you build wealth, like we said, appreciation and debt pay down, right? So if you're buying bigger, better properties in nicer areas, you're getting more appreciation and they tend to cost more, and so you're getting better debt pay down. That's building you more wealth, and that's common in co-living because if you're buying a short-term rental, the best ones are in like touristy spots, but they don't really sell well or appreciate the same way as a property in Atlanta, like a major city where a lot of people are moving in and out of all the time. And then investment opportunities. We have such a massive advantage for anyone who wants to get into co-living, like, well, when I started a couple years ago, but for the next several years, co-living is still gonna crush for the next several, like even after that point, because it's such a necessity. People really need affordable housing, but there's so much investment opportunity because a lot of people might have heard of it. Well, a lot of people haven't heard of it. In sub 2, a lot of us have heard of it, but a lot of people have heard of it, but they don't know what they're looking for. So they don't know how to actually do it. So you have a competitive advantage if you know what you're looking for and how to do it, because other people don't know how to do it yet. Once more people know how to do it, then there's going to be more competition from investors, and that's going to drive up the prices and lower the returns, in theory, right? Because you're competing with more people. So the earlier you get into it, just like if you got short-term rentals 7 years ago or 8 years ago, or Bitcoin, 10 years ago, whatever, all that stuff, the earlier you are, the more returns that you get. And then creative deal flow, like I said, maximize deal flow, scale. So what is co-living rental investing? Very simply, we're just buying a property and renting out by the room, right? You can buy a 4-bedroom, 3-bath and rent that out by the room as 4 individual bedrooms. Or what a lot of people are doing, they're maximizing their returns by buying a larger property, let's say 4-bedroom, 3-bath, 2,300 square feet, and they're turning every single common area, maybe except the kitchen, into more bedrooms. They're turning that extra living room, that dining room, that office, the garage into more rooms because that's getting you way more money. And whatever the cost is to typically convert those living areas into bedrooms has an extremely high cash-on-cash return. Why invest in co-living? Well, you're getting way higher income than you would like a traditional rental. You get way lower vacancy through shared housing. What I mean by that is if you have a rental and no one's living in it in your long-term rental, you're making $0. Well, if I have 50% of my 8 rooms vacant, well, I'm still making 50% of that money. You can't say that with a long-term rental, right? It's like 50% of $8,000 of income, I'm still making $4,000. I'm still able to cover my expenses on that. I'm not bleeding money every single month because I'm spreading the income between multiple tenants. I got some income stuff to show you guys, various properties. But on top of that, if you have one bad tenant or whatever that's non-paying, it's not gonna leave you like you're just totally screwed, right? You have the ability to still make money on the other units until you get to fill it up. So it's diversifying those expenses. Comparable to short-term rentals, where short-term rentals can make similar amount of money to co-living, sometimes even more. The problem with short-term rentals, they're very seasonal. And obviously they've been doing a lot worse over the last several years, but they're very seasonal. So you're not getting income stable throughout the year, which is very advantageous. If you're making your money evenly throughout the year, it's much better owning a business, owning real estate, than it is to have huge periods where you're making a bunch of money in summer and then losing a bunch of money in winter. You got to save that money and expect to, it's not ideal to grow a business. It makes it hard to track and manage your cash flow. You get way more deals if you're informed. Like I said, it's just easier to do it right now if you're more knowledgeable than other people. Very accessible to start and scale. It's really not that hard to learn how to do it and start doing it in the grand scheme of things. And you're providing affordable living for tenants, which is great. I'm not going to get too much into this, but basically, co-living is growing massively. It's projected to basically double in size from around an $8 billion market size in 2024 to $16 billion in 5 years. So by 2029. Understand that even at $16 billion market cap, short-term rentals are at $110 billion. So it's so much smaller than like a short-term rental, like the market size is. So that's why there's still so much room to grow. But the compounded annual growth rate, how much it's growing year over year, is faster than any other strategy out there. So it's still small enough where you can get a ton of investments, but there's a lot of numbers out there, a lot of data to make good informed investment decisions. But the rate at which it's growing is way faster because it's a necessity. People need it and you get way higher returns. We already know people are struggling. It's just super expensive. Wages are not going up nearly as much as housing costs, and interest rates went up, all that shit. Really unaffordable. People need this type of affordable housing. And I'm not talking about people who are making minimum wage. I'm talking about people who make, my average tenant in these co-living homes makes between $40,000 to $70,000 a year, which is around $20 to $35 an hour. And that's like in these other markets, not even in California where it's like, yeah, it's not a ton of money, but like in Atlanta, in Orlando, in Dallas, in those markets where that's still better income, but they don't want to spend 30+% of their income on housing, they'd rather use that money for their life. And so they're preferring that, and that's way better, especially with the deals that I'm buying. People think of co-living as like boarding homes where you're cramming in like 3 people to a room and you're doing it for like $100 a month. Like, it's not what we do. We cater to people who are making solid income, right? 50% of the country makes like $75,000 or less. So 50% of the country is making that income threshold. And we're catering to those guys who just want more affordable housing, and they're really grateful for that. So to show you guys what some of our properties look like, here's one in Dallas where you could see like the black is what the property looked like, and then the red is kind of what it is now for all the rooms and all that. So basically we took this living room and we made it a bedroom. By adding one wall here, we added this wall here and that wall there, plus a door and a door, to turn this dining area into another bedroom. We took this great room. I mean, how many fucking extra rooms do you need? This great room, and that became 2 rooms. This is a little bit off because we actually created another like longer hallway this way so people can we were considering making this one a private entrance as well because that could increase rent for that room. But we said, you know what, let's give everyone 2 points of exit, whatever. So we did that. This office, we literally put a door there and that was a bedroom. This garage is 2 more bedrooms. And everything else was already there as a bedroom. So it was a 4-bedroom, 2-bath. And I'm not a huge proponent of adding bathrooms because there's like permits and all these extra things. But these had huge bathrooms and we just split the bathrooms. So 2 bathrooms, we just split them in half and made them 4 bathrooms. Like literally we took this bathroom and just cut it down the middle and added what was missing. Same with the one over there. They already had a shower and a bathtub. We just needed to add a sink on one side and a toilet on the other side, and that was an extra bedroom. This one was one that we did that burst strategy. We bought it with a hard money loan, renovated it from the ground up. We really designed the layout of it to maximize for co-living, and then refinanced it with a DSCR loan, and we turned this property into a 7-bed, 3-bath property. All the ones here share the 3 bathrooms. There's no private bathrooms, like some of them are private bathrooms, but this is the layout there. And this is less than 2,000 square feet, but because we totally changed the floor plan, we're able to get a lot of rooms and bathrooms, still make it comfortable enough, but there's just a kitchen here and a kitchenette there and no other common areas. There's a laundry room there and then another smaller laundry room there, but like that's it. There's no living rooms, there's no garage, none of that stuff. So some localities, whatever, just local jurisdictions will say, hey, you can only have X number of non-familial people living in a house. So they'll say, hey, you can't have more than 6 people who are not part of the same family living in that house. Or there's, some of them say 8, some of them say 4, some of them say, hey, for every bedroom that's like permitted, you can have 2 people for that. So it's like 4 permitted beds, that's 8 total, right? It depends on the local jurisdiction. City, county, it just depends. It could be statewide. It just really depends on that specific market where you're investing, because anything that is the most local is going to supersede anything else, right? If they say, hey, we don't have any occupancy laws on the state or county level, but the city says, hey, only 4, well, you follow the city. However, and we'll talk about that, I call it regulatory feasibility. I prefer to not be a trendsetter. I prefer to invest in markets that are already successfully being invested in, because they're already saying, even if someone has an occupancy law and says they'll only do 6 rooms, well, if there's a lot of investors there and the data's really good, then even if they have, like Atlanta's a perfect example. They have, I think, a 6-person maximum occupancy. Well, they don't enforce maximum occupancy laws as long as you're following like health and safety standards, right? So you have like 2 points of egress, you have a window and a door at minimum, as long as you're not being a nuisance to your neighbors and all that kind of stuff. And primarily as long as you're also not like triggering building like enforcement to come by and say, hey, why are you doing these renovations that are unpermitted, right? So like it depends. The best strategy to do is to understand the local laws, but then secondarily understand that a lot of places have these occupancy laws, but a lot of the best co-living investment markets have it. They just don't enforce it as long as you follow typical building codes. And then some markets like Denver completely removed occupancy laws. We're seeing more and more of that everywhere. So it's like they had it, but they're removing it. They're saying, hey, we need this type of housing. Follow the building codes so you can have as many people as you want, right? That's like one thing, but a lot of them still have it. They just don't enforce it. Right? They enforce it on a case-by-case basis if you really suck. Actually, we'll see the pad split data for Atlanta. We'll see how many units there are there and roughly how many properties. And you'll see like, okay, well, they have occupancy laws. Well, all these people are doing co-living there. That's a good safe bet that as long as you're following, you're being a pretty good landlord, you're not going to get screwed over by that. All right, so we're not going to get too far into it, but co-living is better because it makes more cash flow than like a long-term rental or a mid-term rental. But more importantly, it's also more consistent income than a short-term rental. And I get to buy bigger, better properties in better locations that appreciate more. I mean, it's all of those combined. Here's an example of one of the properties in Atlanta that we own. We have properties that make $2,000, $3,000 plus a month in cash flow. This is a standard $1,700 a month cash flow property. To understand, as a long-term rental, someone might not buy this property because they said, hey, if this thing's going to lose money as a long-term rental, I don't want to buy it even for co-living. Well, I don't care about that. I'm not buying it as a long-term rental. I'm buying it as a co-living property. In the worst case scenario is I lose $47 a month potentially with all these reserves, but I'm making $1,700 a month in cash flow, operating it the way that I want to with all these reserves as well, with over $1,500. That's $3,200 a month compared to how a lot of people, actually a lot of people don't account for the reserves when they're analyzing deals like maintenance and vacancy and all that. We do. So a lot of these cash flow numbers can seem lower, which is really high, this deal in general for most people. It could look higher if I just didn't include those reserves that a lot of people just forget to include or choose not to include. All right, so as a long-term rental, this thing could make $2,600 a month and then as income and then lose around $50 a month in cash flow. Well, the same property makes $6,866 a month in income, even with $1,200 a month towards utilities, services, and insurance, like higher insurance, higher vacancy, higher management, and higher maintenance. We're making $1,700 a month in cash flow. So the question is, how many properties like this will allow you to be financially free? I don't know. I mean, we're in California, so it's a little bit higher for us. But, that's kind of the idea is how do you get more things like this? I'll leave it at that. This was a creative deal. All right, so this was a $385,000 purchase price, 10% down payment. It was sub-2 deal at 3% and seller finance at 3%. So it was very good debt on top of the fact that, co-living makes more money. I show this just to show like kind of the comparison. Even though you're spending more for the right deals, you're making so much more that your cash flow is significantly higher. It's not like I make, just because it's $6,800 a month, I'm not making $4,000 more. I'm making $1,700 more because my expenses are also higher, right? And we'll get into the numbers behind that because I know that was a question. And then just as importantly, it's not just about making more cash flow, because understand, if I bought this thing as a regular rental, it would cost me around $75,000 right there, $74,000 entry cost. But because I'm buying it as co-living, well, I also have to build those rooms. I have to furnish the property. So it's going to cost me $110,000. So remember, increasing the cash flow is one thing. Well, what is that relative to the amount of money I have to put into the deal, the cash on cash return? We're going from negative cash on cash return, because if you're losing money every month as a long-term rental, it's always negative. You should not buy negative deals. This thing is $1,700 a month of cash flow and 18% cash on cash return. That's like a really great deal. You only need a couple of those to be financially free. And the goal is just make your money work a lot harder for you. That's why co-living over other strategies. This is really cool. This is 2 different properties. This is actually a much smaller property that we have in Atlanta. But this one's like really nice. It was a lot of what we've been doing is buying people's failed short-term rentals. Like Atlanta has a lot of properties that people buy as short-term rentals and they don't understand like other strategies. So like they're just bleeding money and they're gonna lose to foreclosure, or we buy it creatively with low entry and we end up making a shit ton of money on those types of deals. We do that kind of all over. The main markets you think of, like Orlando, right? Like all the short-term, like think of these short-term rental markets where they need to sell because they're gonna lose it to foreclosure. We did that with a Dallas deal where they were $16,000 in arrear. They paid $8,000 of it. We paid the other $8,000. We took over the property subject to from them. They paid to sell the property. They paid $8,000 of the mortgages they weren't paying. Said, well, if we're going to lose it, we're just going to lose it to foreclosure, because we were able to save them for foreclosure. They said, okay, we'll pay the $8,000. We'll pay for half of it. And then we're making over $2,200 a month in cash flow on that one deal. And it's like over $3,500 without the reserves accounted for. Because we understand the strategy. We know what we're looking for. That's kind of what I'm trying to get you guys to do, is understand these are just regular properties out there. The difference is you're looking at a different viewpoint than everyone else, until everyone else also starts looking at it like that, right? That's just what happens. The market gets more and more saturated with more and more investors, because if something's really good, people are going to learn and do more of it, and you're going to have more competition, and it's not going to be as great. So I show this just to show you guys, like, people are like, oh yeah, like how long do people stay? Well, these ones, we've had people stay for over a year. This one's even longer now because a lot of these tenants have stayed with us, like 2 years at this point. They're staying with us. Showing you guys kind of the weekly rents, because on the pad split platform that I utilize for some of our properties, they collect income weekly. And then here's another one in Savannah, Georgia, 8-bedroom, 5-bath, and they also, the income weekly. This was screenshotted like newer into maybe like 2 months after we got it set up. So they were there for a lot less time. That's why they're all kind of starting around the same time frame. For 54 days, so between 54 days In 20 days, that's what, 35 days, we went from no occupants to a full house for an 8-bedroom house. To show you, and within 30 days, we got this property fully rented out and making thousands of dollars a month in cash flow on a deal like that. And to show you, like, if one of these stops paying, cool, well, that sucks, but at least we're still making a ton of the money nonetheless. Because that's how you lose the real estate game, right? Tenants stop paying, or something big comes up, you can't afford it, then you lose the foreclosure, all that cash flow that you thought you had is gone now, and then you don't get the wealth building benefits because you lost it. Well, that's what co-living does. People sometimes think of it as more risk because how do I manage my tenants? How do I do all that kind of stuff? And I get that. Like, I get why that'd be a concern if you're the one who has to do it. But in my opinion, the bigger risk is buying properties that barely cash flow or are really dependent on one tenant for the income stream. Spreading out that income and making significantly more income allows me to build a better business that I don't have to do the day-to-day work on. And if something goes wrong with a unit or two, it's not destroying my entire business. All right, so co-living, so better strategy because of higher cash flow, higher appreciation, right? Way higher cash flow, way higher returns. Better appreciation because remember, I'm buying the typical long-term rental. You're buying in some shitty-ass little town like sorry if you're from Missouri, but some little Missouri town to make maybe $200 a month of cash flow, and that's like your thing. Well, that's not, maybe you make $200 of cash flow. I'm gonna make 10 times that in co-living in Atlanta. And markets in Missouri are not going to appreciate nearly as much as a market like Atlanta and Orlando and Dallas, right? Bigger, better markets that people are actually moving to. And I get to buy bigger properties, right? The typical long-term rental that makes sense is, 2-bedroom, 3-bedroom. Well, I'm buying 4+ bedroom properties, and those tend to sell for higher at the exit in the future. Higher debt pay down, when I'm buying properties that are bigger properties that have bigger debts, people are like, well, they think of it kind of the opposite, where they think like, oh, bigger debts, that's bad. That's kind of true, right? If it's a bigger debt, it's like, well, you're paying more in a mortgage, but I'm making more in cash flow than I would otherwise. So yeah, it's bigger debt, but the income is so much higher that I'm making so much more money on it. Plus, my tenants are the ones paying down that debt for me. I stack that with creative financing at low interest rates, and they're paying down my debt faster and faster and faster. Cash flow is necessary for financial freedom. I make 5 times as much in wealth building every month than I do in cash flow. I make easily over $20,000 a month in cash flow. I make 6 figures in wealth building every single month in my portfolio. Through appreciation and debt pay down, I'm building so much freaking wealth every single month between my tenants paying down my debts and my properties appreciating in value, in addition to the cash flow that my family and I live off of, which is all tax-free. It's like so fucking crazy to me. Like, it blows my mind because as an engineer and like thinking through it, like the systems and all this, it's like, it's just such a cheat code if you know how to do it, right? That's the hard part, is having the confidence to do it. And yeah, the higher tax benefits. So, the bigger the property, the purchase price, the more tax benefits. And we do renovations and furnish. All that is also tax deductible. Some of it's expensed and it's an instant tax deduction. Some of it is depreciated, so you take tax deductions over time. I did a whole video last week on taxes for an hour. I just live on YouTube. Bonus benefits, right now there's less competition and way higher accessibility, right? Because most of these properties that we're buying, they really cater well to creative financing, not just as like failed short-term rentals or whatever, but like buying a property on market that is a 4-bedroom, 3-bath, 2,200 square foot that most homeowners cannot afford. That makes it that I can structure creative financing to solve that seller's problem. And most investors don't understand co-living, so they're not even looking at that property anyway. They're looking for that $200,000 2-bedroom, 1-bath, and I'm like, I'll buy a $450,000 4-bedroom, 3-bath with really great creative finance terms because I have less competition from investors and homeowners right now because they're priced out of it. Because homeowners are not thinking of how can I structure it creatively. And investors aren't even looking at properties like that, most of them, unless it's co-living investors, because they don't understand this stuff, which is great for you guys who do. Easier to find property service professionals. This is big, so like I learned this when I started my investing was when I was stationed in Alaska. One of the hardest things is in a market like Alaska or Missouri or whatever, I just say the whole state, I don't know, I can't even think of a city there. One of the hardest things is you're gonna be stuck doing a lot of the work if you can't hire people, right? So I can find 100 property managers, 100 contractors, 100 handymen, 100 cleaners in Atlanta. Well, in Alaska, in Fairbanks, Alaska, where I started my investing, there's 3 property managers. I've already fired 2 of the 3. This third one sucks ass and they just increased my pricing. I can't do anything about that. There's literally no competition, so they can charge whatever they want and they can provide terrible quality. That's not the case in bigger, better markets. That's a really big advantage as you're scaling to realize that, because pricing is lower and they're doing better. And if that doesn't work, you just do the next one, use the next one. You can't say that when you're buying them in smaller markets. And then for me, we provide housing to people who need affordable housing. The reality of it is these guys can't afford to buy these larger homes. People are typically not able to afford it, especially not the people who need this type of housing. Buying a 4-bedroom, 3-bath as a long-term rental doesn't benefit the majority of people that can maybe cater to one family, but they're gonna pay a lot of money to be able to live there. Whereas we can provide 6 to 10 people affordable housing, typically 30 to 40% less than what they would be paying for a 1-bedroom. They can rent the room instead. Yeah, so it's better for renters. We get to provide that for houses that don't really take away from the people that need affordable housing. It's not we're taking 1-bedroom, 1-bath, or 2-bedroom, 1-bath properties that these guys may be able to afford. We're taking these bigger houses that most people can't afford anyway. We're creating affordable housing from it. I can't say that with my short-term rentals. I've got some really awesome, I got a multi-million-dollar mansion some of you guys have probably been to when I hold meetups in San Diego. That's sick. I love that property. But I don't feel as good about that property. Like nearly, it's a cool property, but I don't feel nearly as good about my short-term rental properties and that kind of stuff than I do my co-living properties. I love the fact that we get to provide affordable housing, but at the end of the day, we are investors. It's first and foremost about the much higher returns. If I wanted to provide affordable housing and not care about the investment returns, I would just donate the money and just do charity, which I already do, right? This is an investment, and your goal is to make a shit ton of money as efficiently as possible. And if you get to also benefit and solve some problems, that's sick. So I'm not one of those guys who pretends like I do all this to solve world hunger, well, I guess affordable housing, but it's a really nice benefit that I can't say with my other rentals. And the cool part is you make a ton more money so you can be a better owner. I'm not, like I said, I'm not putting multiple people in a room. I'm not like being a slumlord. I'm making so much more money. I can take care of my properties and take care of my tenants much better. I can pay for, I can improve the property much nicer. So this is the Savannah, Georgia one. That one is, this is an Atlanta one. These two are another Atlanta one. This is that 5-bedroom, 4-bath one. Really nice properties that are gonna appreciate a lot of in value. If you buy better properties, take care of your tenants, they're more likely to take care of your properties and take care of you. That's just how I've always thought about it. On a spreadsheet, it almost always looks better to be a slumlord, to save money and cut costs and not do things. But if you're making thousands of dollars a month of cash flow, my opinion is you should be a really great steward of that money. Take $100 of that, do the landscaping. I send supplies to the house, like the trash bags and the paper towels and all that kind of stuff to make it easier so there's less who's gonna do it and all that stuff. So there's less operational concerns because it's like, hey, we're already supplying the things people might argue about. And it's just like nicer. For us, spending $75, it's not even $75 a month. We put that on the spreadsheet. It's like less than $30 on an Amazon subscription to just send this stuff to them every once in a while. Like it's so easy to pay for a house cleaner to come by every time they turn a room to also clean the common areas and to clean the common shared bathrooms. I like doing that kind of stuff. You can only do that when you make a bunch of money. You cannot pour from your cup into other people's cup if your cup isn't full. My cup is very full, it's overflowing. I can give to them as well, which is awesome. And you do earn more. Like you'll see, like this is the selfish part about it. Like the better your properties, the better it all is. I get less operational issues, so my tenants stay longer because I'm providing them better housing and taking care of them more. They're paying 15% above market, 6% above market. A lot of this is because this was a year prior to this, it was still above market a year later, right? So like, how do I phrase it? It was even higher than that a year prior because we can make more money because we're catering to a certain audience that wants to pay more for a more premium product, or a more premium property, right? They're paying more because it's a better property and where our rooms are full and they're staying full longer. Same with these, well, this one's like, yeah, so like 20% above. That's literally telling us you're charging more than we recommend. Well, I don't care what they recommend. People are willing to pay it because they think, because it's worth it to them, great. Because we're not providing the average product. We're providing something that's better than the average. That's usually the goal. And it means we make more money per month, but also we keep our tenants longer because the most expensive thing is turnover. Right? When tenants move out, well, there's vacancy. Then you got to bring someone else in. Pad split and property managers tend to charge more when a tenant just moves in, like initially the first month, and you're losing money when they're gone. And then they could like cause damages and all this. Like keeping your tenants happy, getting them there early, like filling your rooms faster, having them pay premium rent, keeping them there longer. That's like a recipe for massive success in real estate investing, especially co-living. Like I said, being a slumlord looks better, to save that $75 a month, to not take care of your properties or renovate them well or buy shittier properties. It looks better on a spreadsheet, but I guarantee you, the reality is the better the properties, the better you take care of your tenants, as long as the numbers make sense, the better it is overall. I could model that in lower vacancy and say, oh, this is what it would be if you had less vacancy, but what I do is then I supercharge these deals with creative financing. Because creative financing, as a lot of you guys know, is way freaking better than traditional financing. If I'm getting lower interest rates, that means I'm making more cash flow, right? The same loan with a lower interest rate, I'm paying less a month on that debt, right? That's the biggest expense, is typically the debt payment. That means I'm keeping more money. I'm making more money per deal. Lower down payments means, right, if I'm putting less money to buy that deal because of creative financing, I could put 5 or 10% down, like that one of the deals I showed you, versus 20, 25% with traditional financing. That means I am getting higher cash on cash returns. Because remember, to increase your cash on cash return, you have higher cash flow. Well, lower interest rates means more cash flow, which is increasing my cash on cash return. Lower down payments means lower entry cost, right? Which means higher cash on cash return. And that gives me more money to invest in other deals. Even if I'm not using my own money, if instead of using $200,000 to buy a deal, I can buy it for $100,000, that's another $100,000 I can use to buy another deal. Not only is that first deal's returns better, but now I have another $100,000 to buy the next deal. And it's more scalable. It's way easier, not easier to find the deals, but it's way more easier to buy properties that are creatively financed than to go through the entire traditional process of getting loans and the financing and the appraisals and all that other shit. And because the higher returns and lower down payments, that makes it more scalable because, like I said, the best way to raise money is to provide better deals to your capital partners. Well, if I'm buying properties with higher cash flow and lower down payments, so higher cash on cash returns, that makes it easier to buy more deals. And I'm wasting less money with banks on appraisals and all their fees and all the other crap they charge and the higher interest rates and all that other stuff. It's a recipe for massive success. I would say simple example, and it kind of is. Okay, so it's like if I bought a property traditionally, 25% down payment, versus the same property creatively, 10% down payment, I'm spending $57,750 less. I'd still have to spend the same amount of money to renovate the property, to furnish it, and all that other stuff. But I'm spending $57,750 less to buy the property. And if I'm buying it for $38,500 creatively as a down payment, that means I can go buy 1.5 more properties with that same amount of money that I just saved. Plus, if the interest rate is lower, my loan payment is lower, which means I'm also making way more money. Just to visualize it a little bit. Yeah, so getting $853 more in monthly cash flow, it's an extra $10,000 a year. Like I never thought of it as, how do I buy, this, the question that I dislike is like, oh, how many units do you want to be financially free? That doesn't make sense. Like it's not about the number of properties or units you have. It's about how much money you're making in total. It's about the cash flow. Well, if I can, my goal has always been, how can I make more money with the least amount of properties, with the least amount of work? I'm like lazy in that sense. It's this massive superpower. I don't want more properties for the sake of it to flex on people. It's because I want to buy properties that make me a lot more money per deal. If you can make an extra almost $1,000 a month, $10,000 a year, that's significantly less properties you have to buy. That's the goal. No one really, I mean, maybe you guys do, but most people don't want to manage 100 properties to achieve the same cash flow if you could just do it with 10. And yeah, save more money, plus the lower interest rates. That means you're paying the debts down faster, which is building more wealth. That's why I build so much wealth each month, because almost all my deals are creatively financed. Even the traditional ones have lower interest rates because I was doing more of that in 2022 and before. I do have, yeah. So I mean, my tenants are paying down my debts faster, building more wealth because of the lower interest rates. Higher returns means everyone wins. So like I said, higher cash flow and higher cash on cash returns means for buyers, you're getting financial freedom faster with less properties. That should be your goal. To get, if your goal is financial freedom, how do you do so more quickly with less properties? Because you have more properties, there's more operations and more stuff you got to deal with. Because it's not about the financial freedom, that's one big piece, but then it's about time freedom. That's what I had to learn in my journey. It's not just about the financial freedom. Well, that doesn't mean anything if you have money coming in, but you're spending all your freaking time working in this real estate business. That's not actual freedom if you got to spend all this time managing 100 plus properties because your deals don't make sense or you bought lower cost deals or you can't outsource property management. The goal is to get financial freedom and also time freedom. That means you have to buy assets that allow that to be possible. And typically the less properties you have, the easier it is to manage that whole portfolio. It's better for capital partners. Once again, better returns it's better returns, so it's easier to raise money, and it's better security for them. If there's more money, like if you're making $100 a month in cash flow and something goes wrong, your projections are wrong, and now you're $200 less a month, well, now you're losing money. You're losing money. If you cannot sustain to pay to lose money every single month, you're going to lose that property. That's not a lot of security. Well, if I'm buying a property with $1,500 of cash flow a month after setting aside over $1,000 in reserves, if that thing makes me $500 less a month, I was wrong about my income. So I go from $1,500 to $1,000 a month in cash flow. That sucks. I want to make $1,500. I want to make even more than that a month, right? But if I'm making $1,000, that sucks, but it's not the end of the world. The end of the world in real estate investing is Well, there's a lot of end of the world, but one of the big ones is buying properties that are losing you money every single month. Because now you're just putting money into a money pit. That shit sucks. The protection for you and for capital partners is the bigger the cash flow spread, the more security you have. That's what co-living allows for. And for bird dogs and wholesalers, where if you're bringing greater deals and there's more of these great deals, you make way more money by selling them to people who want to buy better deals. I mean, the better the deal, the more money that you make, especially in creative financing, because it's typically buy and hold rentals. Cool. So here's an example, let's say for my bird dog wholesaler people, like this is a deal that we paid $25,000 to the wholesaler and the bird dog combined. You can't really do that for creative financing. It's very hard for most creatively financed deals to do that unless there's a ton of equity. This one had no equity. Well, they still got paid $25,000. Why? Because even with their $25,000, we still had a 20% cash on cash return, making $2,200 a month in cash flow after setting aside $1,200 a month in reserves and paying $1,500 a month in private management. Like, we can pay for all these costs, still make a ton of money, and pay the bird dogs and wholesalers a solid amount of money because we're making way more money. The more money your deals make, the better the deals, the more everyone can make, and the easier it is to be able to outsource the stuff you shouldn't do. Shit, how many of these would you need to be financially free? And for a lot of you capital partners, how many of these deals do you want to be part of? That's really the question. They want to be, when you bring someone, if you're newer and you're bringing someone $100, $200 a month long-term rental, and someone else is newer, but they're bringing them something that's going to make $2,000 a month, even though you're both newer, which one would a capital partner rather invest in? Well, the deal that makes more money, obviously, regardless of experience, right? I was going to say, compared to me bringing this type of deal, but that doesn't work because obviously they'd give me the money. But okay, so, and this is a big one. I put this here for you guys to see. This return is after also accounting for $17,000 in reserves. All that wiggle room as well on top of that, and it's still 20% cash on cash return. That's really not possible without doing co-living, which you're gonna get like 5 to 15% cash on cash return with traditional financing. Then you get to like the 12 to 30% cash on cash return with combining co-living plus creative financing. Because going co-living is better, you know, whether it's traditional financing or creative, co-living is better than long-term rental. That already gets you much higher returns. For the right deals. Not every single deal that you do co-living is going to work. Please do not think that's what I'm saying. But for the right deals, you're going to make way more money doing co-living than long-term. And then you combine that with creative, you make it even better returns. That combination is really great. And a lot of deals that work well as co-living can also work really great as an opportunity for creative because there are these properties that are bigger that are just sitting there or failed rentals from other investors who just need to get out. Yes, I showed this because roughly what you can expect is around, it depends on the amount of renovations that you're doing. But typically what we see is, this was in total what? It wasn't $67.5. It was $130,000 for the entry cost. People ask me, roughly how much does it cost to do a co-living deal? It's gonna depend. When I do creative co-living deals, it's $85,000 to $125,000 per deal. If you were to do the same deal instead of 10% down payment, we'll say it's a 25% traditional loan. Well, if it's a $400,000 property, instead of doing 10%, which is $40,000 down payment, you're putting 25%, which is $100,000. So that's an extra $75,000 for you than for me if you're going traditional risk. So like, understand that 85 to 125 is because I'm buying deals from wholesalers, so there's more entry costs involved, but the deals tend to be better and they're better overall because it's creative versus traditional. Like, so it's like, oh, why would you pay a wholesaler $10K when you could just go find a deal? Because if I get to buy these deals with less work and pay someone who's worked really hard to find me a deal like this, I'm happy to pay them. And the deal makes more sense than just buying something traditionally. So yeah, I just show this to kind of show the breakdown. Typically, like I said, $85,000 to $130,000 roughly for creative co-living deals. If you're doing traditional, expect at least another $50,000+ for traditional. So this one was asked, cost to acquire co-living rentals. So every single property that you buy creatively, right, or even traditionally, but every single property creatively, you guys have probably heard of the various entry costs. Well, all the acquisition costs are the exact same. Right? To buy a property, whether you're doing long-term, mid-term, short-term, it doesn't matter. It's the same cost to buy that property. It's the same down payment or cash to seller. It's the same arrears or liens if you're paying that, if that's involved with the deal. Same agent and wholesale commission, same closing cost. Regardless of my strategy, it's the same cost. The difference for co-living are, well, I gotta renovate it and convert those common areas to bedrooms. I gotta furnish the property. And then you're gonna want bigger reserves because if you're buying a property and you're just gonna rent it out right away, you might need 1 month of reserves until you fill it up. But if I'm gonna renovate it and furnish it and then fill up 8 rooms, I might want a month for renovations or like 2 months for renovations and furnishing, and then another month right? 3 months of reserves to also get it filled up and producing income. So those are kind of the more costs you can expect is the renovations and furnishing costs. And then other, like your carrying costs or your reserves are gonna be higher typically. Cool, that's really the difference. It's not like substantially more. The question a lot of people have is, well, how do I know what the renovations are and this and that? I get you. That is a little tougher to explain because it's market dependent. I've got a lot of baseline numbers and it depends on how you're converting. For example, it's way lower cost for me to take this office and add a door. That's like less than $1,000 to make that a bedroom. I love that shit. I love buying turnkey properties that are laid out really well, and I'm gonna talk about that, my favorite types of things to, conversions to do. But to buy properties that are pretty straightforward and the layout is so good that I can low cost convert and create more rooms. So that's the lowest, right? The office, you can expect like $1,000 for a door and maybe an armoire, right? Like maybe you don't add an actual closet, but you're gonna add drawers or an armoire or something like that for a closet. You don't need to put a permanent closet. Then the next one is converting these dining rooms and living rooms by adding a wall or two and a door. I project roughly $6,000 per room, but if I was doing one of those rooms in a house, it might cost $10,000+ because you got to get the contractor there. But when you're doing a lot of them, on average, it's like $4,000 to $6,000 per that because all we're doing is we're framing, insulating, 1 or 2 lines of electrical if you do that, and drywalling, mudding and taping, adding a door, a couple times. So that costs a couple grand, and the more of those you do in a house, typically the lower the cost is per room. So I project typically $6,000 for rooms like this. A little bit less when it's like this, but predict this is like a shared wall, right? This is like a shared wall, so it's less rooms. And then you have your garage conversions, which I put roughly $20,000-ish for those garage conversions, roughly, because it depends on the amount of work you have to do. If it's already finished, right, it's already finished, so it's already got insulation and drywall, well, it's a lot less work. But if you have to, like you're just putting some flooring and minimal stuff, maybe you're closing off the garage permanently or from the interior, but if it's all like exposed, you guys know what I'm talking about, when it's like all exposed studs and all that, well, you got to insulate it, then drywall, it's going to cost more. You got to do the flooring and all that kind of stuff. So, I put roughly $20,000 for garage conversions to convert the garage, and then another like $3,000 for that extra line down the middle, right, for that extra wall. So it's $23,000 to create 2 rooms. It's really dependent on your market, the level of conversion that you're doing. I prefer to buy turnkey properties, really nice properties that have all the major renovations already done. A lot of these properties for sale, or the ones that are bought from short-term rental owners, they're already really nice freaking properties. And then all I'm doing is I'm doing very low-cost conversions because I want to buy these deals with as little money as possible so my cash on cash return is higher. So I'm buying properties that don't have huge renovations or huge general property renovations they need to get done, but then also a lot less conversion costs they need to get done, right? Like we considered not doing this because this is the most expensive conversion. However, because we were able to get 2 rooms in there, it still really justified it going from 8 to 10 beds. It just that cash on cash return. Really, is the extra $23,000 worth an extra $1,000 a month in cash flow? Got you. That's basically what you do. You just kind of analyze, is that worth that cost? All right, the next one is cost to operate co-living. What are the difference in costs? Well, if it's like a long-term rental, you're not typically covering utilities and that kind of stuff. So the extra cost to think about, we have the fixed expenses, right? The mortgage payment, right, which includes the principal and interest of the loan, so the debt payments, taxes and insurance. Well, the taxes and debt payments are the same. You're probably gonna have to pay more for insurance, so you'll see that there. You're gonna cover the utilities, so water, sewer, gas, electric, garbage, all that kind of stuff, like you would with any furnished rental. Then landscaping, house cleaning, owner-provided supplies. See, I overestimate. I'm a little conservative with this when I analyze deals because I'd rather make more money than I say we're gonna make than the opposite, which sometimes happens too. Like I'm not perfect, but and then the management costs, right? You gotta have to pay for property management. If you're utilizing the pad split platform, they charge 8% income for the property. 8% of the income they charge. However, when a new tenant moves in, they keep the first 10 days of income. They keep 33% of the first month of income when a tenant moves in, and it's 8% after that, those first 10 days. To keep 100% the first 10 days, and then 8% after that. That translates to around 12% when you have a tenant turnover every 9 months. You're typically gonna need another property manager as well, because even with the passive platform, which I'm not gonna get into the weeds of today, you still need to do some of the property management. Like you still have to like move the tenants in and coordinate the cleaners and all that kind of stuff. Vacancy, maintenance and CapEx, all that good stuff. So there are more expenses, but then the income has to justify it, right? And then that cash flow, the extra cash flow, has to justify the entry cost. Great. I'm not gonna go too far into this. 3 filters for great co-living markets. I say market feasibility, investment feasibility, and regulatory feasibility. Market feasibility, are you investing in markets that actually need affordable housing? right? There's no point of providing affordable housing to markets that don't need affordable housing. Are these markets that are growing and they're appreciating in value? So it's not only that they need co-living, but these are great markets to invest in general as a real estate investor, so they're appreciating more in value. Investment feasibility. Can I actually buy rentals in this market? You can buy properties in highly unaffordable markets like New York and Miami and San Diego and Los Angeles, right? Because they need affordable housing, but they're not very investment friendly. They're really expensive and they don't tend to make you a lot of cash flow. They have other benefits, but don't tend to make you a lot of cash flow. And then regulatory feasibility. Are room rentals allowed? For example, the occupancy laws. And if they're not allowed, they have occupancy laws, do they actually enforce it? For me, I think of our other investors operating there successful and what are they doing to be able to do so? Other key things to consider in a market: population size and growth rate, job growth and workforce diversity. Like I said, most of my guys are not like fast food workers. They're not making minimum wage. They're making $20 to $35 an hour. Those are healthcare professionals, hospitality professionals, military, blue collar, skilled trades, logistics, warehouse guys. That's kind of my main demographic. And lower rental vacancies. So like there's not a lot of there's a lot of competition for, 2-bedroom and below, like one bedroom, 2-bedroom units. So they really need more of that. I don't tend to target college kids in particular. I don't like just choose like, oh, there's college, so I'm going to go there. Nor do I say or discriminate against if there's a college there. I just focus on where are good investment markets, which the cheat code is PadSplit, the PadSplit platform. You don't actually need to pay PadSplit any money to use their free tools. You create a free account on there, you get access to their host map, which is basically a map telling you all the blue dots are their core markets. Where are investors, where do they have lots of properties currently? The gray is where are emerging markets. Where are markets that are just starting out, may not have a property yet, or maybe just have like 1 or 2 and they're starting to grow. I focus on core markets. You want to know what market should I invest in? Well, make your life easier and don't worry about 50 states and hundreds of cities. Look at the blue markets and then decide which of those make the most sense for you. How do you do that? Well, when you click one of those blue dots, it'll literally tell you, hey, here's Atlanta, Georgia. This is a little outdated because it's always being updated, but 7,200 active units and around 200 more coming up. So there's almost 7,200 units right now available, not available for rent, but in that market that are rented by the room, whether available or not, and then another 200 that are coming up. I approximate around 7 rooms per house on PadSplit. So I don't know what that math is. 7,400, 1,000 houses, basically. Translates to 7,000. So.
Question on the wholesaling side of things. Like, if I was looking at this and wanted to find like who the owners are, does it enable that type of thing? If I wanted to figure out like buy box.
Does PadSplit?
Yeah.
Oh, so you can find buyers, so you can sell.
Yeah, like finding things to wholesale, and I wanted to find like.
Cool, I got you. You don't even need to do all that extra work because I have a community called Real Estate Freedom Roadmap, which a lot of people are either wholesalers and bird dogs focused on active income. There are capital partners, and then a lot of buyers. In my mastermind community, super investors are 50 plus actual investors doing co-living in various markets, and you can get 50 buyers immediately right then and there. That you can go from, instead of doing all that extra work and tedious of time, you can find the buyers that already want to buy creative co-living deals and are happy to pay people a good amount of money because I teach them. That's the better use of their time, is to pay people working hard and want active income so they can buy these deals with less of their own work. So that community, which I'll give a link for, you can just go find a bunch of buyers and say, hey, I am a wholesaler looking to provide really great co-living deals in these markets, or I want to understand your buy box so I can find these deals. Who is looking for it? You're going to have no shortage of people saying, dude, add me to your buyers list. And have a whole list of the super investors that you can, to work with them, their contact info and all that. So this tells you like literally everything. If you want to know how many units are there, what is the demand, this is how many people, unique people, have searched in Atlanta in the last 30 days, unique people, different IP addresses, different computers that have searched, actually different houses. Well, I don't know how IP addresses work. So almost 40,000 people have searched for 7,400 active units in the market. Well, 7,400 active units does not mean that there's 7,400 rentals available. Because there's an 89% average occupancy. So 90% of that 7,000, would you say 7,000? 7,000 is already rented out. So only roughly 10% of 7,000, 700 units are actually available to rent for the 39,000 people that have searched in the last 30 days for 700 units available. Most people don't even know that piece. They look at the units relative to the demand, but they don't realize, well, 90% of those are full. And then a lot of those are shitty ass properties by shitty ass landlords who took photos with like Nokia brick phones, and so it's like terrible photos, or they have terrible rentals, they're way overpriced. So you're not even competing with 700, you're competing with 50% of those guys, whatever. So it's like 40,000 people searching. So is that a good market to invest in? Even though Atlanta's their first pad split market and it's saturated, a lot of people say, oh, there's too many people investing. Great, well there's 40,000 people searching right now for less than 700 units. Is it saturated? No, there's a shit ton of people still looking for housing like that. And it'll even tell you how much, on average, you can get per week if it's a shared bathroom or a private bathroom, right? Because you get more if it's a private bathroom. And each of these are zip codes in Atlanta, and you can click each of these and get even more granular data. You never have to pay PadSplit a single dollar to get all this information. That's the cool part. You can do all this, learn all this stuff. Choosing your market, so use passive market data to simplify market research. There you go, we'll leave it at that. Ideal co-living properties. So you want properties that end up being around 6 to 10 bedrooms by the time it's all said and done when you're done renovating. 6 bedrooms is kind of like the bare minimum if you want to make like $1,000 a month. When you get to that 7, 8, 9, 10 is how we're talking about $1,500, $2,000, $3,000 a month in cash flow is those higher rooms. Because a property's cash on cash return isn't that high if you just rent it out by the room. Right? If you just rented a 4-bedroom, 3-bath property out by the room, it's not going to be a really great return. It might not even be worse than a long-term rental. But each additional room, even though it has more cost, each room has such a high cash on cash return, it drags up the overall property returns. Don't want to get too far in the weeds of that, but that just means the more rooms that you add, typically the way more higher cash on cash return, higher cash flow you're going to get. So I like to not buy a single property that is going to be less than 6 bedrooms. In San Diego, I have a 4-bedroom, 3-bath that works in San Diego, but that's not going to work in most markets. That 5-bedroom, 3-bath works in Atlanta because it's such a premium rental and the debt is super great. You don't want more than 4 people sharing a bathroom. 3 to 1 is better. You want a functional kitchen and property layout so you can have easier conversions like that Dallas one I showed you. Much easier to convert that into rooms. You need adequate parking, and it's going to be very important to have adequate parking, whether it's driveway parking, whether it's in the backyard, whether it's in the front, whether it's at a corner lot. And why it works is it maximizes your rental income potential, but it also maintains tenant comfort and retention. Like I said, it's not about making more money. Sorry, like 2 more minutes. It's not about making more money. It's about keeping your tenants who are paying more money, getting them to move in sooner, getting them to pay more if the property's worth it, and getting them to stay longer. That's how you make a lot more money in co-living. That's how you reduce a lot of the operational headaches. Reduce bathroom conflict when you don't have too many people sharing bathrooms, and it's way easier property management when the property's laid out well. The ideal houses, so how do you get 6 to 10 bedrooms? Well, you're going to want typically properties that are no less than 3-bedroom, 2-bath. I like 4-bedroom, 3-bath minimum, unless there's like unfinished basement or garages or things like that. At least 2,000 square feet, ideally, just to make your life easier. Does it mean that you can't buy, like I said, 1,800 square foot and make that work? Sure you can. But if your goal is to, and I do a whole demo when I do my 3-day co-living, like my free 3-day co-living challenge, but I just show you, like if you looked at every property in Atlanta, there's like thousands for sale. Well, then you filter by 3-bedroom, 2-bath, whatever. Like the more filters you have, the less properties are available. Great. You can't, just because there's more properties to look at is not a good thing. You have to spend time to look at all those deals. So if you can find the best ones, that's what we're doing here. We're just filtering for the things that have the highest likelihood for success, and you're not spending time looking at thousands of properties. You're looking at 100, dozens, right? And then you look at days on market. If it's been sitting for a long time, maybe you can give them a freaking call. Try to pitch creative, give them the terms that they want to buy that deal that no one else will want to buy because it's overpriced, probably, and then you can maybe get it creatively if someone else already didn't call and ruin it for you. Large common areas and multiple living spaces are very nice. Like I said, what the hell is a great room? A great room, a dining room, a kitchen, an office, all these things that transfer so easily translate into more rooms and more income, adequate parking, as I mentioned. So when you get that, you're not really going to have like driveways that can house 10 people, but you want at least roughly 4 spaces right there. And ideally, corner and end lots are better because then you can have people park. Because that's the best way to piss off your neighbors is to have your tenants park in front of your neighbors' houses. So you want things that have adequate parking, ideally in the driveway, maybe backyard. We do a lot of that, like gravel out the space and just provide more parking on our lot. And then also like if it's a corner or end lot is great. And they don't want HOA or rental restrictions. That's just an extra hassle to not deal with. So the occupancy laws is one thing. Well, an HOA might say they're cool with it until they're not cool with it, and they can just change the rules anytime that they want. I don't even want to deal with that shit. It's not worth my time. And property renovations are a must. So like I said, you're not going to just like buy a property and rent it out by the room typically and have good returns. I did that in San Diego. That's not very common. And it was like okay returns, just more wealth. Your goal is to maximize your return on investment with little impact to tenant quality of life. So you want those larger square footage properties with ideal floor plans that are easier to convert, so it's less money to convert those units. Convert those common areas that we talked about, and preferable to not add bathrooms because it's more costly, takes more time, more risk. Typically for bathrooms, we get that permitted, which also costs more time. It takes, costs more time. Takes longer and costs more. But the biggest thing is to just have a repeatable system. So whatever you want to do, whatever strategy you want to do, just understand okay, here's why I want to do it. The best advice is, Casey mentioned, right? Just choose what you want to do and then just stick to that thing. For me, I feel like I've pretty much perfected something that makes a lot of financial sense to buy single family homes, which are way easier than an RV park or mobile home park or multifamily. Not that they're wrong. They just, for me, my goal is cash flow and high cash return and buying a significant amount of those properties. Multifamily tends to provide you get some money up front. You don't make as much cash flow typically because you're usually increasing the value of the asset and then making a shit ton of money on the exit. A lot of people, they want financial freedom. Well, that comes from owning properties that cash flow you. Even if it's but an RV park can make you $10,000 a month in cash flow versus $1,000 in co-living or $2,000 in co-living. But by the time you find an RV park, by the time you learn how to find it, structure it, buy it, operate it, and make all that possible, you may or may not make several $1,000s in cash flow, but I've already bought 10, 20 properties and I'm already financially free. That's kind of the idea. It's more accessible to find single family homes and easier because there's so many properties out there and they're conducive to creative financing because we're buying these bigger properties that are sitting, as opposed to the 20,000 RV parks, 10,000 owned by institutional buyers. You're competing with a lot of people for less assets that require more operation. I'm lazy. I don't want to make a bunch of money if it's going to cost me a ton of extra time and effort. I'd rather just do the thing that makes a good amount of money that's easier to do. So if you find a good strategy, just stick with it. I just gave you mine. Creative, co-living, capital raising. If you guys want a bunch of free trainings and courses and other tools, not all this stuff is free. Some of this stuff is free. And then I have my co-living community in there too. I have other stuff, but it's more for existing investors looking to scale or cap partners who have a lot of capital that are just looking to just fast track financial freedom. But a lot of this stuff is free. Like these three are all free. So active income and all that stuff. I want to help people make money without them having to spend money. I hate people spending money, trying to make money. They really need to learn how to make money, but then they're spending money. It's that's not really helpful for you right now. But people charge a shit ton of money. I just give it away for free. I make it easier for you guys. I'll teach you the basics of real estate investing and deal analysis, co-living beginner's guide. I do have my co-living freedom community, which is the step-by-step blueprint on literally everything about co-living, plus weekly support calls with my operations manager who does all the property management, asset manager who does all the renovations and furnishings and property setups and creating our teams and all that kind of stuff. Get you insurance quote providers and all that kind of stuff that you typically ask about, and deal analysis to help you guys where people typically get stuck. It's one of those three things. So we do all that. You're welcome to check it out, but no obligation. I gave away a ton of stuff for free. And then here's my Super Investor Calculator, the free version, which allows you to analyze deals creatively and co-living. It's any form of acquisition. Cash, traditional, all forms of creative, so seller finance, sub 2, hybrid, Morby, and then all the strategies. So, not all of them, but long-term, mid-term, short-term, and co-living, but I use it for creative co-living deals primarily. I use it for every deal, but that's primarily what I'm buying. So you can do that on there. I got a really cool tool coming out, but you guys can't use it for probably a month or two, but it's gonna make it really easy to analyze these deals. It's basically the spreadsheet as a online tool that's already ready. Now we're pulling data in from other sources, so it's gonna automate 90% of the work. Still have to do some of it, but it's going to automate a lot of it. And then, just importantly, it's going to allow bird dogs and wholesalers to submit deals, and then it's going to help match those deals to buyers. So you don't even have to worry about buyer assist and all that. It will literally automatically do that, match it with the right people's buy boxes, and then help them analyze it so they can make a decision way faster. It's fucking insane. How to find capital partners, especially with less experience. Honestly, I don't think people should be finding capital partners and raising money with less experience. I think the best thing you can do is gain your experience. You can do what I did, which is house hack, or use your own money to buy deals to start off to gain experience. Or you can bird dog, so get paid to learn how to find deals for buyers once you feel your confidence is better. You can either try to do those deals yourself, you can partner with people that are more experienced, or if you have money, this is the cheat code. If you got money, if you got $100,000, instead of using that to buy your first deal, you can partially raise money. You put in $50,000, you raise $50,000. So then your $100,000 now turned into 2 deals, but more importantly, more deals, more experience, and you have capital raising experience, which translates into it makes it easier to buy, because now you went from 0 to 1 to 2, and not just on the real estate, but also on the capital raising side. That makes it a lot easier. Was that helpful? That piece? Okay. That's like a variety of the more money you have, obviously, in real estate. The biggest cheat code in real estate investing is having money. It's a fact. One of my account partners, primarily, almost all the money I've raised are like people like you guys. People who are in communities, investing communities who need, like almost all of my capital was raised, not through family, not through friends, not through I've been retired for so long, W2, I don't even know. With my coworkers, yeah. I've only ever raised money from people that want to do real estate already, and I'm providing them something that they couldn't do otherwise. They either have the experience or the time to find those deals, and what I'm doing is I'm providing them that opportunity they otherwise couldn't on their own, for the most part. So that most of mine are other investors who just are in communities that I'm part of that want to be part of these deals. Whether some of them want to be fully passive, they realize it, like, oh, it's too much work. Like, I go through that and like, fuck, I want the ownership. I don't want to do any of that. Like, that's a big way to raise capital. But also those that are partner with me to then be able to do this independently. So one of the biggest cheat codes people do is they partner with me. They provide the money for the deal. They're owners with me. They learn, and then they then go and now do that for themselves. The thing is, I've shot myself in the foot a little bit because I have this great co-living community and all the resources. That's almost better for them. To pay $197 a month for all that is way cheaper than spending $100,000 to $120,000 to partner on a deal. I have so much capital raise, it doesn't really matter, but it is an actual detriment. Like, just go to that. This is what you need instead. It's way less costly for you. How did I structure and find my first deal? My first deal was a 50-50 split, and I don't do that anymore. But I did that because I don't know. That's what I thought you had to do. And the earlier you are in your capital raising journey, like because you raise capital one way when you're starting out to get a deal done doesn't mean that's how you're going to do it forever. So like now, typically my capital partner is getting 20 to 40%, depending on the deal. It's really deal dependent. This one was a phenomenal deal. And it had $100,000 of equity, really high returns, all this good stuff. We still did 50-50 because that's what I thought I had to do, and I didn't have the experience. I was raising money out of desperation, which I see a lot of people do. They're only now looking to raise money after they found a deal that needs to close. As opposed to what I do now is I'm always raising money, and I'm always pre-raising money. I always have hundreds of thousands, if not millions of dollars ready with aligned partners to then bring them those investment opportunities. So I'm not coming from a place of desperation. I'm choosing who do I want to partner with, and we're already in agreement on the terms. So I did it. Yep, go for it.
Are they verbally confirming with you on how much they're going to give you, or are they actually putting their money into like an account?
It's all verbal for me. I don't need them to put money in anywhere, but it's like I have a process. I got like a forum. We get on a call, we talk, and then at that point I'm identifying alignment. Right? Do they actually want to invest with me on these strategies? Do they understand what we're doing for a longer time period? Like, what is their overall goal? So we're doing like an alignment call, and then I'm realizing, okay, you have this much money. Here's what you want to accomplish. They have $300,000 and they want to do what I do. I'm like, well, cool. Let's try to get you in a deal that gets you experience. May not be as high as returns, but it'll be lower entry, so you can do that and then use that money to grow your portfolio. So I try to match the deals in the returns that makes the most sense for the partner. Some people are doing it for tax reasons. Some people are doing it to be purely passive. Some people are doing it like that to be a more active investor. So I try to match that, and that makes it a lot better. So not just great investment opportunities, but then matching it to the type of capital partner. Although sometimes I just blast it out to all my capital partners, and someone's like, yeah, I'll fund it. So that also happens. Loan products I use, I said all of them. Max partners a deal 4. Okay, cool. We answered all those questions.